Many people think losing money only happens when we make obvious mistakes, like overspending on shopping or forgetting to turn the lights off before leaving home. But the truth is, most people lose money in ways they don't even notice. These quiet, repeated losses slowly eat away at your finances over time, making it harder for you to save, invest, or get ahead. The good news is once you're aware of these money traps, you can take simple steps to fix them. So in today's video, we'll look at 9 ways that you're losing money without even realizing it. 1. Subscriptions you don't use. Many people sign up for subscriptions and then forget about them. These can include streaming services, phone apps, software, magazines, or even gym memberships. The problem is that these charges keep showing up month after month, even when you're not using the service. To avoid this, review your credit card and bank statements carefully. Write down each subscription you're paying for. If you don't use something at least once a week, consider canceling it. That money could go towards savings, debt repayment, or other financial goals that matter more. 2. Lifestyle inflation. As your income increases, it's natural to feel like you can afford more, whether it's dining out more often, buying brand name clothes, or upgrading to the newest phone. This gradual rise in spending is called lifestyle inflation. While these upgrades may feel deserved, they can quietly eat away at your ability to save and invest. Over time, your monthly expenses rise, but your financial progress stays the same. So to avoid this, aim to keep your living costs steady. Use your extra income to pay off debt, build savings, or invest for your future. 3. Eating out too often. Eating out is quick and enjoyable, but the costs can add up fast. Restaurants often charge 2 to 3 times more than what you could make the same meal for at home. So if you eat out frequently, it can take a big bite out of your budget without you even realizing it. A good habit is to limit restaurant visits to once or twice a week at most. Plan easy meals, make a grocery list, and cook at home more often. Even packing your lunch for work or school can lead to savings of hundreds of dollars each month over time. 4. Bank fees. Bank fees can quietly drain your money if you're not paying attention. Overdraft fees, ATM charges from other banks, monthly maintenance fees, and late payment penalties can add up to hundreds of dollars a year. Many people don't notice these small fees until it's too late. To avoid them, always track your account balance, set up alerts, and pay your bills on time. Stick to using ATMs from your own bank whenever possible. You can also switch to a bank or a credit union that offers no fee or low fee accounts to help you save even more. 5. Credit card interest. Carrying a balance on your credit card can be costly. With interest rates often over 20%, even small purchases can end up costing you more over time. This means you're not just paying for what you bought, you're also paying the bank extra money every month. To avoid this, always try and pay off your full balance by the due date. If you're already in debt, create a plan to pay it off. Start with the card that has the highest interest rate, or explore balance transfer offers with lower rates to reduce your interest costs. 6. Low interest savings accounts. Traditional savings accounts typically earn less than 1% interest, which means your money growth is very slow. Over time, inflation can reduce the value of your savings, making your money actually worth less. To get more from your savings, consider switching to a high-yield online savings account. These accounts often offer interest rates of 4% or more and are safe to use if they're FDIC approved. They're a great option for storing your emergency fund or saving for short-term goals. Earning more interest helps your money grow faster and helps you keep up better with inflation. 7. Staying in debt too long. Holding on to debt for too long, especially high interest debt, can cost you a lot in interest payments over time. For instance, a $40,000 loan at 6% over 5 years could cost you around $6,400 in interest alone. That's money that could be used to build your savings, invest, or pay off other expenses. The longer the debt stays, the more it drains your finances. Paying off debt faster reduces the total interest paid and frees up money for more productive uses. Focus on extra payments or debt repayment strategies to help speed up the process. 8. Overpaying for insurance. Many people end up paying more for insurance than necessary, or they hold on to policies that don't really fit their needs. For example, coverage like accidental death insurance or whole life insurance often isn't needed by most people and can be costly. To avoid overpaying, it's important to review your insurance policies at least once a year. Consider working with an independent insurance agent who can help you shop around for better rates. Also, increasing your deductible can lower your monthly premiums, but make sure that you have enough savings to cover that deductible if you ever need to use your insurance. 9. Buying new cars. New cars depreciate rapidly, losing about 20 to 30% of their value within the first year alone, and over 50% in 5 years. When you finance a new car with a loan, you end up paying interest on a quickly depreciating asset, which increases the overall cost. A smarter approach is to buy a used car that is around 3 years old, but still reliable and well maintained. This approach lowers the purchase price and slows depreciation, helping you save money while still driving a dependable vehicle. Losing money isn't always caused by major financial mistakes. More often, it happens because of many small, repeated decisions that seem insignificant but add up over time. These can quietly drain your resources without you realizing it. The key to stopping is understanding exactly where your money goes each month. Begin by setting up a monthly budget, carefully tracking your expenses, and regularly reviewing your spending habits. By making small intentional changes to your financial routine, you can improve your money management and build stronger financial stability over time. If you enjoyed today's video, then feel free to like, comment, and subscribe. And if you want to learn about 5 basic money skills that everyone needs to know, then check out this video. Thanks for watching, and we'll see you again next time.